Good morning. You're watching a live market outlook for Tuesday, 22nd of November 2011. The Eurozone debt crisis swept closer to the heart of Europe despite a clear-cut election victory in Spain for conservatives committed to austerity, adding to pressure on the European Central Bank to act more decisively. Spain's socialists became the fifth government in the 17-nation currency area to be toppled by the sovereign debt crisis this year. Portugal, Ireland, Italy and Greece went before, while Slovakia's cabinet lost a confidence vote last month and faces a general election in March. An absolute parliamentary majority for Mariano Rajoy's center-right Popular Party brought no respite on financial markets, increasingly alarmed by the absence of an effective firewall to halt meltdown on sovereign bond markets. Rajoy kept investors and Spaniards guessing about his plans to tackle the crisis, saying the constitution will make him wait until just before December 25th to name an economy minister and explain how he will get 5 million people back to work. The risk premiums on Spanish, Italian, French and Belgian government bonds rose as investors fled to safe haven German bonds, while European shares fell more than 3% after Moody's warned that France's credit rating faced new dangers. The Eurozone Economic and Monetary Affairs Commissioner Olli Rehn said that this crisis is hitting the core of the Eurozone, and the Eurozone officials should have no illusions about this. He defended the European Union's executive advocacy of austerity policies, blamed for choking off the growth and jobs. One simply cannot build a growth strategy and accumulating more debt when the capacity to service the current debt is questioned by the markets, Rehn told the Brussels seminar, and one cannot force foreign creditors to lend more money if they don't have the confidence to do it. Greece's new technocrat Prime Minister Lucas Papademos, on his maiden trip to Brussels, won an assurance that Eurozone finance ministers should be in a position to agree at their next meeting, which is due next Monday, to disperse vital bailout fund to avert bankruptcy. Papademos was expected to meet European Central Bank Chief Mario Draghi today evening in Frankfurt in Germany. Borrowing costs for both Spain and Italy hit levels regarded as unsustainable last week before the European Central Bank stepped in temporarily to steady the market. The two newspapers said the ECB Governing Council had imposed a weekly limit of 20 billion euros on purchases of Eurozone government bonds, a figure analysts say prevents it wielding a massive deterrent power in the markets. Germany's central bank had led resistance to the bond buying it sees as inflationary. The latest weekly figures released yesterday showed the central bank bought nearly 8 billion euros in the week of last Wednesday, far below that reported limit in a week where Italian and French spreads hit euro area highs. Critics say this reluctant piecemeal approach in aggravating the situation rather than restoring confidence. ECB Governing Council member Ewald Nowotny, regarded as a DO, told a conference in Vienna that the central bank could not simply start printing money, but would have to discuss its next response to the crisis. From the other side, the rating agency Moody's said a recent rise in interest rates in French government debt and weaker economic growth prospects could be negative for France's credit rating. This is actually the third hint of credit rating companies for possible downgrading of France's current AAA credit rating. The French government spokesman insisted on Monday that Paris would not impose a third package of budget savings despite market pressure and costs of credit. Talk of a possible breakup of the 12-year-old single currency now is growing among analysts, mostly outside the euro area, as Eurozone paymaster Germany has rejected most of the widely touted solutions for the debt crisis. Some comments from the analysts saying the Goldman Sachs asset management chairman O'Neill said the crisis of European Economic and Monetary Union meant big decisions have to be taken pretty quickly, and it's not obvious to him that Eurozone Monetary Union could survive without Italy. It's not obvious also that Italy can survive with the 6 to 7% bond yields, so something going to have give pretty quickly. Italian bond yields have got to come down pretty quickly, or European Monetary Union will have some severe challenges. Also, Dutch finance minister, one of the Berlin's closest allies, acknowledged that the Eurozone could splinter. Asked whether a breakup of the Euro would cause economic depression, he told this could be a consequence from the Eurozone falling apart. That's correct. The chief executive of Deutsche Bank, Josef Ackermann, said Greece leaving the Eurozone would cause incalculable damage and make it less likely that Greece would pay its debts. From the other side of the ocean, the US lawmakers abandoned finally their high-profile effort to rein in the country's ballooning debt on Monday, in a sign that Washington likely will not be able to resolve a dispute over taxes and spending until year 2013. The admission of defeat by Republicans and Democrats on 12-member congressional so-called super committees likely to cement perceptions among voters and investors that politicians are too divided to tackle $1 trillion budget deficits in national debt that now is roughly equal to the US economy. But lawmakers will be less willing to compromise as they shift their attention to the November 2012 presidential and congressional elections. The finger pointing began within minutes of the announcement. President Barack Obama said at the White House that Republicans had scattered the talks by refusing to consider tax hikes on the wealthy. President Obama said they simply will not budge from a negotiating position, and so far that refusal has been the main stumbling block that had prevented Congress from reaching an agreement to further reduce the deficit, Obama said in the White House. Comments from rating agencies, Standard & Poor's and Moody's announced yesterday that there will be no immediate downgrade of their credit rating on the United States due to the failure of a congressional supercommittee to reach an agreement on debt reduction. But Fitch, the third leading rating agency, which currently has the most positive rating of the three on US debt, said it could cut the outlook on its AAA rating with a downgrade on an outside possibility. From today's calendar, the events due coming at 9:30 GMT from UK public sector net borrowing. Forecast for today is drop to £4.1 billion compared to the previous month, 11.4 billion British pounds. And then from Americas, Canadian retail sales monthly expected unchanged at 0.5%, as well as core retail sales unchanged at 0.4%. From US, preliminary quarterly GDP is expected slightly to drop to 2.4% compared to the previous quarter's release at 2.5%, while consumer confidence in Eurozone due at 1500 GMT is expected to stay unchanged at -20. Later in the afternoon, there is Richmond Manufacturing Index forecasted at -2 compared to -6 the previous month, and today's late in the afternoon the FOMC latest meeting minutes are due to be released. Let's now take a look on the markets and see what were the latest movements in the majors and the commodities in past 24 hours. We are starting with the euro. As we can see, the pair is currently consolidating, still in the consolidating mode of the recent down move from 142.46 as the low at 134.21 posted on the 17th of November still holds the downside after yesterday's renewed 10th lower was contained at 134.29, just above the previous low, keeping the pair within the directionless range, limited on the downside by 134.20. On the upside, initial barrier currently being under attack at 135.40 zone, above which we have the next level set 135.55 and then 135.65, the main bear trend line drawn from 142.46 high. The upside, the ceiling of the recent range is at 136.14, and currently only break above the trend line, and this level would signal some stronger recovery. However, the outlook for the euro dollar remains negative, and the further losses are favored. A strong support at 134.21, as well as the weekly Ichimoku cloud at currently at 134.07 holds the downside for now, and the possible loss of this level to extend gains, losses towards 133.76.60 zone initially. That is the last barrier ahead of possible stretch down to the key support at 131.45, which is the low of 4th of October. On the upside, the immediate barrier, as mentioned, has been tested now, 135.40 ahead of 135.55. Pardon. And only break above trend line and the range top at 136.14 would signal some stronger recovery. However, the market remains firmly capped at 138 zone and maintains the short-term negative trend, as also being heavily pressured by negative fundamentals coming on a daily basis from the Eurozone countries mainly. The cable also consolidates. Actually, there is attempt to base at the levels just above 156, as yesterday's low 156.11 still holds after overnight's fresh push lower was contained at 156.18, just above this level. However, the latest weakness seen yesterday through 156.90 and 156.30 supports is keeping the focus to the downside, as the current bounce is seen corrective, while 157.40, our initial strong resistance hold. Initially, actually, the first resistance comes at 156.90, as this was the previous support, now reverted to resistance, but upside axis should be capped at 157.40, where also comes the 20 days moving average on the 4-hour chart. The MACD is again breaking below is in negative territory and breaking below the signal line, signaling further losses. Break below 156 handle is to open, which is also 61.8% of the broader up move from 152.71 to 161.64, saying below 156 to open 155.41 low of 12th of October, and then we have 154.83, which is 76.4 Fibonacci retracement of the entire move higher. As shown on daily chart, the studies are firmly bearish, with MACD currently breaking below the central line, as well as the momentum, and the 55 days moving average currently at 157.82, capping the any upside attempt. Dollar yen regained some ground after hitting fresh low at 76.56 last Friday, and steady gains were accelerated through 77 barrier after comments of Japanese finance minister during the Asia session. That was a sort of hint of possible intervention. Actually, the investors most likely misunderstood the comments, as he was talking about possible further loading money in the market in order to prevent fresh strength of yen, but there was no talk of intervention, and this spike was the immediate reaction of the market. The near-term tone now turns positive, as we can see that studies on the hourly chart are above the midlines, as well as 4-hour studies approaching, the MACD is approaching now the midline, while regaining momentum through the midline might signal some stronger recovery. 20 days moving average currently at 76.91 acts as initial dynamic support, and while holding above this level, the immediate focus stays at the upside. Regain of 77.31 overnight low is to open the next spike high at 77.48. However, the more negative outlook is seen on the daily chart, as false break through 90 days moving average on the daily chart, and 20 days moving average capping the upside action keeps the downside more in focus, as the studies are pointing lower. As mentioned, 77.50 break above 77.50 is to turn the near-term focus higher for possible test of the key upside barrier at 78.00. On the downside, the break below 76.85 to turn the immediate focus lower, 76.74 and 76.56 to come in focus on the break of the previously mentioned levels, with the loss of 76.56 to resume the short-term down move from 79.52 post-intervention high, and the focus 76.30, 76.10, 76.00 as our next short-term targets. Dollar Swiss is facing some difficulties to clear initial barrier at 92, as yesterday's brief break above this level was stopped at 92.07, and the pair keeps moving in the consolidative range of the stronger short-term rally from 85.66 up to 92.34, the high posted on 17th of November. Immediate risk now is at the downside, as the weakening hourly studies are risking attack at 91 and the key near-term support at 90.83, loss of which would open way for a stronger correction of the recent move higher, and likely to expose the psychological support at 90.00 ahead of next Fibonacci level, which is 38.2% at 89.77. Holding above 90.83 keeps the immediate bullish tone in play, and the clearance of 92.34 is expected to open our next targets at 93.13 and 93.38, which is the 27th of March 2011 high. Commodities are in near-term recovery mode, as we see the gold dipped sharply yesterday, breaking through our initial support at 17.05, 16.95, dipping down to 16.66 so far, and retracing exactly 50% of the move from 15.32 low of 26th of September to 18.02, the latest peak posted the 8th of November. The immediate outlook on the short term remains negative as the studies are deeply in the negative territory, and the current bounce on oversold conditions faces strong resistance at 1710 zone, as well as the short-term consolidative range ceiling at 1737, above which is required to trigger some stronger recovery. However, the negative outlook sees this move as corrective. As we can see, the 20 days moving average at 1714 joins the initial barrier at 1710, and break here is to open 50% Fibonacci retracement at 1730, and then comes the key barrier at 1735, which is also the low of 11th of November, and basically it's expected to contain the corrective bounce and to maintain the short-term downtrend from 1802 high. The crude oil is also in the corrective near-term mode after hitting fresh low at 95.83 following a strong rally last week, when the pair rallied from 98 zone through 100 zone to test our target at 103.35 that was touched on 17th of November, ahead of sharp reversal that completely erased the latest rally and dipped below our next strong support at the 97.20 zone, cutting the losses to as low as 95.23 so far. As we can see, this also tested the 200 days moving average on the daily chart, pardon, the 20 days moving average, 200 days, I'm sorry, that so far contained the strong reversal, and holding above this level keeps the immediate broader pictures positive tone in focus for a possible fresh attack higher. Loss of 95.67 200 days moving average and 95.23 yesterday's low would signal further weakness of the crude oil, and possibly to target the next level, which is at a 94.58 high of 20th of October, and then 38.2 Fibonacci retracement at 92.50.